A net operating loss, or NOL, happens when business deductions exceed income for the year. Post Tax Cuts and Jobs Act, most taxpayers can't carry an NOL back anymore. Instead, the default rule is carry it forward to future years. On the EA exam, they'll test that no carryback is the general rule, and then hit you with the special exceptions. For most businesses, the carry forward is indefinite. You keep using it until it's used up, or for individuals, until the taxpayer dies. But there's a cap when you use it. The NOL deduction generally can't exceed 80% of taxable income in the carry forward year. Translation: even with a huge NOL, you usually can't drive taxable income all the way to zero. Now the big exception. Certain farming businesses and insurance companies can still do a 2-year carryback. That means you can apply the loss to the 2 prior tax years to potentially generate a refund. On exam questions, look for keywords like qualified farming business or an insurance company. Those are your carryback triggers. If a carryback is allowed, you can claim the refund 2 ways. One is the slow and steady method, amend the prior year return. The other is the faster tentative refund route using a standalone form. C corporations use Form 1139. Individuals, estates, and trusts use Form 1045. EA exam tip: match the entity type to the right form. There's also a hard deadline to use those tentative refund forms. Form 1139 and Form 1045 must be filed no later than December 31st of the year after the year the NOL arose. Miss that date, and you're generally stuck with amended returns instead. On the EA exam, they love asking for this deadline because it's oddly specific. Finally, even when a farming business qualifies for the 2-year carryback, it can elect to waive the carryback and just carry forward. Why do that? Maybe the loss is small, or prior years had no taxable income, so a carryback won't produce a refund. The election is made by attaching a statement to a timely filed return. Watch for that phrasing in farming NOL fact patterns. Many years ago, Cedar Ridge Farms built a barn for $50,000. This year, it was worth $70,000. Then it was destroyed by a tornado. At the time, the adjusted basis was 0 because it was fully depreciated. Insurance paid $70,000, and the farm spent $66,000 to rebuild. What's the tax consequence? Options include recognizing all the gain, recognizing only part, or treating it as non-taxable. Think about it. The correct answer is that Cedar Ridge Farms must include $4,000 in taxable income, and it can postpone the remaining $66,000 of gain. This is an involuntary conversion under Section 1033. Realized gain is $70,000 because basis is 0. You can defer gain only to the extent you reinvest. The tempting wrong answer is non-taxable, but partial reinvestment means partial recognition. Hawthorne Advisory is a calendar year C corporation. In 2023, it has $100,000 of capital losses and $50,000 of capital gains. Prior year capital gains were $20,000 in 2019, 0 in 2020, $24,000 in 2021, and $9,000 in 2022. What is the corporation's capital loss carry forward to 2024? Think about it. The correct answer is $17,000. Net capital loss for 2023 is $50,000. C corporations don't deduct net capital losses against ordinary income. Instead, they carry the loss back to offset prior year capital gains, then carry forward what's left. Here, it absorbs $24,000 from 2021 and $9,000 from 2022, leaving $17,000 to carry forward. A tempting wrong answer is $50,000, forgetting the carryback.